Welcome, everybody. Thank you so much for coming. Tonight, we're going to be talking about how to invest in real estate without becoming a landlord. One of my favorite topics, and my friend Sam Wells is here with me, and it's one of her favorite topics as well. We have been told that the only reason more people don't do this is because they don't know about it. They just don't know
Ex-
that the opportunity exists. Uh,
Exactly.
so, this is just a chance to give a 10,000-foot view of what we do and the options that are really out there for regular people. Don't have to be high net worth individuals, regular people that can become real estate investors without taking one tenant phone call in the middle of the night. Don't have to do any of that. So I'm just going to go over real quick the basics. Sam and I both are active investors, and what we do is we buy large multifamily properties, like apartment complexes, and then we partner with passive investors and we bring them along with us to become part owners of the property. And then all together, we share the cash flow that the property produces every month, and we also share the profit at sale and the tax benefits, and all the wonderful things that come along with owning real estate. So it is not a Ponzi scheme. It's legit. We've done it. We've had many investors and we've had many repeat investors, and it's a great way to just diversify your investment, if nothing else, so that all of your eggs are not in the stock market in one basket over there. Every deal that I've done so far has been higher returns than I've ever gotten in any of my stock-based investments. And like I said before, the tax advantages, they're different for every person, but they can be very significant depending on your situation. We also get a lot of retirement account investors. So if you thought that you had to have your IRA or your 401k in the stock market, that's actually not true. In many cases, your employer will let you self-direct that, and you could actually invest that in real estate as well, which is a really cool option. So our values, integrity, taking care of investors first, that's what we're all about. And I'm going to let Sam introduce herself. She's a great gal.
Thank you so much, Hillary, for having me on. I was laughing because it took me about 3.5 years to convince my family it was not a Ponzi scheme. And now there I was a running joke at Christmas time for a while, and now they're all multifamily lovers. So I thought that was a great way to start. I'm Sam Wells. I live in Charleston, South Carolina currently, with Lake City Equity. Lake City Equity is me, my husband John Wells, and our partner David Igowitz, who goes by Iggy. We love the Southeast. We're majority in Georgia and South Carolina, Charleston and Savannah. And we have partnered with passive investors over the last couple of years and have just over 1,000 doors.
Perfect. Yeah, and I didn't truly introduce myself, so I'll do that now. I'm Hillary Graves. Hi, everyone. And I'm out of York, Pennsylvania. So I invest here and there, and I love the Southeast. Besides that, it's a great place to live and that you live there. Can you tell us why, from a real estate perspective, South Carolina and Georgia, and why are those great for real estate?
Yeah, absolutely. The first thing is both South Carolina and Georgia are landlord-friendly states instead of tenant-friendly states. So that's number one. And then the second, we look for an MSA of 100,000 or more population. So Savannah's about 400,000, and then Charleston is just over 800,000. And then we always look for median household income and median household values. We want to make sure those check the box first. So income has to be at least 50,000 or more, really probably about 80,000 or more. And then household values 250,000 or more. So those are the first couple of things. But in Charleston and Savannah in particular, it is industry. Both are port cities, so a ton of logistics, ton of warehousing, auto manufacturers. You've got Boeing, Bosch, appliance manufacturers, military, tourism. Don't even get me started on tourism. You can't go downtown and get a table anywhere at really either location, Savannah or Charleston. Just booming weddings, film. The You've got SCAD in Savannah, Savannah College of Art and Design. So really, just looking at the markets as a whole, and what's there now and who's coming in. As far as the ports go, Savannah is the largest port on the East Coast, and can is actually the only port that can take mega ships coming in. So just a tremendous amount of growth in both those areas, which is what we always want to see.
Absolutely. How are you finding these opportunities that actually cash flow? How are you finding with high interest rates today, any opportunities that actually make sense numbers wise?
The first thing is I'm looking at hundreds of opportunities that don't make sense is the very first thing. I have built relationships with really brokers, people who are boots on the ground and who know exactly which sellers are, what their price is and what makes sense. And I've got relationships now where they'll say, the pricing on this one I know doesn't make sense. They'll tell me right off the bat. But we're really looking for assumable loans right now, and sort of a crazy, debt market. And then also seller financing, because we've got good long-term fixed rate loans where we don't have to worry about what interest rates, are rising or not. But it truly is, building those relationships with brokers, and then underwriting and looking at a ton of deals that just don't make sense, to find the one that we really want to say, hey, at this point, the deal flow really is so good that we just pick and choose which one we really, want to take down and partner with.
Awesome. Can you real quick go over like what is an assumable loan? Because probably a lot of people don't
Yes,
know, and
yes,
also
sorry.
seller financing as well.
Yes. So an assumable loan is where, let's say someone has either with the bank or most it's agency debt, which is Fannie and Freddie. Not to get too much into the weeds, but they bought a couple years ago when the interest rate was in the fours, and they have maybe 3 years interest only. A deal we closed recently had 9 years interest only left on the loan, 4.64 interest rate. So we as the buyer actually come in and can take over their loan, so it's a win-win for the seller. They're not paying a prepayment penalty, and then we're getting really good long-term debt on the asset that doesn't have a floating rate. We know what the interest rate's going to be, and regardless of whether or not the Fed hikes rates or what they do throughout the closing process, we know what our loan proceeds are going to be, and we know what our interest rate is. So there's no guessing game when you're underwriting. And then seller financing, the seller actually is the bank. So they may do anywhere from 60 to 100% of the loan. And, you certainly can negotiate different terms with a seller who's not underwriting it like a bank would, and have certain coverage ratios that a bank would. So seller financing is a great way to take down an asset.
Thanks for covering that. Okay, I want to show a sample investment opportunity. This is a really shortened version of it. It's usually more 20 something pages often, but just to get an idea, if you were to become a passive investor in one of these opportunities, that you would get a lot of information up front about what you can expect going forward. And we start with the apartment. We've got maybe some pictures of the apartment. We talk about the area and why this market is one that's worth investing in. And then we show you the return profile where you can see what you can expect for average per year that you're going to be getting in cash flow. So basically what our income is minus our expenses, including our mortgage, is our cash flow, and we share that amongst our investors. And it's often in the sevens or eights, somewhere around that range, 506B. That's for opportunities we have that we're only offering to our friends and family and people that we know, that we have an existing relationship with. And that's something that's required by the SEC. So if we file it as a 506B, it's limited to people that we know. So that's another reason a lot of people have not heard of it, because we're not publicly advertising a lot of these opportunities. The split is how the returns are kind of divided between the active investors, which would be the GPs, general partners, and the passive investors known as LPs or limited partners. And 70% of those returns, often 70-30 is pretty common. 70 goes to the passive investors or the LPs, where 30% goes to the active investors or the GPs. We give you your average annual return. As you can see here, that actually factors in, this is a really high number, right? It just like seems an impossible return, but that is achievable because we are factoring in not just the cash on cash, but also the profit at sale. So if you annualize all of what you would receive as a return, it actually comes out to around 20% per year. And so that's also reflected here in the equity multiple. We call it an equity multiple because if you put in, let's say, $100,000 as an investment, you can expect to double it plus a little bit within 5 years and turn your $100,000 into $200,000 in the course of 5 years. And I'm just saying 5 years because that's kind of a typical hold period. They're not all 5 years. Some are less, some are more, but we like to just give you an idea of what you can expect in that time range. This also varies the minimum investment to get into one of these opportunities, but $50,000 is kind of pretty typical. I don't usually see it less than that. Sometimes it is higher than that, depending on the opportunity. But just to give you an idea, there is a little bit of a threshold there that it's that does limit some people from being part of it. So if you only have 5,000 or 10,000, maybe you can check out one of those group investments that where you can just literally put in $1,000, be part of real estate that way. So that is not what we do. Ours is property specific, and our minimum is usually around 50K. We give you an idea of the business plan, which usually involves some kind of value add. It's very difficult for us to reach the numbers that we're looking for if we can't somehow add value. Maybe the rents are low, or maybe there's an opportunity to um, add a dog park or add additional amenities that are not there currently and are not being charged for. So we try to increase the value in several different ways, and sometimes we decrease the expenses, and that's one of the ways that we can kind of improve our cash flow and also improve the overall valuation. We give you a really specific idea of projected returns. So this is not it's not a guessing game. I mean, this is not necessarily exactly what you're going to receive, but as you can see, we're getting down to the single digits here of projections, and we can do that because we have a lot of data that we can put into our spreadsheet with the rents that could be expected in that area and how much our expenses are to the penny, as close as we can get. And that gives us a really good idea of what we can give our investors. And this is based on a $100,000 investment again, but you can kind of see here the cash flow that you would receive each year usually starts a little lower as we're getting the operations going and maybe renovating the property. But then it starts to ramp up, and there's also a nice big profit at sale. This is that idea of doubling your money in 5 years. You've more or less made what you invested in the first place, and then you get back your original investment. So $100,000 turned into $200,000. So that's kind of how that works. And then there's just the basic, this is the next step. So if you'd like to be involved, we give you a link to a portal where everything is totally on the up and up. We have a lot of attorney drafted docs for you to sign. And like I said, we do register it with the SEC. So we have you go into the portal and reserve your investment and then eventually wire. Anything else you want to say about that, Sam? That this step of the process?
So the only thing I'll say is I didn't know I could buy a multifamily. I did not know what the SEC was. So that is the Securities and Exchange Commission.
Oh,
Um, a lot of people, maybe people know, maybe everybody knows, but and they're responsible for regulating, protecting investors essentially.
why, for just use an example, why did my own mom not get on board with any of my opportunities until the third one? And the answer is she had these what ifs in her mind. And she did express some of them, but it wasn't until the third opportunity that she said, "But what if there's a hurricane that just takes out the whole thing?" You know? And well, what if you guys have to declare bankruptcy? And she came out with all of these things that had been on her mind. And, there actually are things that we have in place to address that.
Those really are great questions. I mean, essentially, most folks are handing us their livelihood, and we have and do the same thing. So, number one is we invest alongside. The general partnership team usually makes up about 5 to 10% of the total equity. So, my money is being invested right alongside with our investors, and it's treated the exact same way. So, it's great to be asking those questions. Number one, passive investors do not sign on the loan and are not liable in any sort of way for any bankruptcy, negligency, anything like that. So that's obviously when you're passive, you truly are passive. And then number two, insurance is huge. Each property has its own liability, casualty. We have separate hurricane policies, and honestly, all of those cover the property and the income that is lost should there be an incident. So this is a terrible story, but in Dayton, Ohio, actually, where my husband's from, one of our associates owned a property there, and he hadn't owned it for that long, and a tornado came roaring right through. It was a significant amount of the unit. There were no casualties, so that's another reason I'm telling this particular story. Well, from the insurance money, they got not only the income from those 50 units while they were being repaired, the insurance company also covered obviously all of the repairs. So they ended up, I mean, in a very short time period, improving that property over and beyond what they ever would have. So you never want a tornado roaring through, but I just use that example to say that we make sure we're covered in the event that something like that happens. And the attorneys are the ones. We have syndication attorneys, SEC attorneys, and they draft the private placement memorandum docs, and that's what you will see in the portal that Hillary was talking about. And it's 60 pages truly of legal documents. So if ever we're starting a deal and we're working with a new investor, oftentimes we can send them the PPM docs before we actually open the portal so that they can get familiarized. We can send them a deal that we've done prior just so they get an understanding of the process. But that's the biggest thing. A lot of people they have some cash that they want to invest, but they don't have time, nor do they want to be truly active. You can be a passive investor and not have any of the liability of, insurance damages, loan recourse, all of that stuff. You can truly be passive.
Right. And absolute worst case scenario, if we need to declare bankruptcy, investors are not liable for losses beyond their original investment. So, but some other people don't have an extra 50K lying around somewhere. Whenever I'm talking to somebody who says, "Yeah, I have $60,000 in the bank. I want to go for it." I always just take pause with that. If this is something that you expect at any time that you would need access to, this is probably not for you. Maybe not this time. Maybe save up a little bit until you feel really comfortable parting with that amount for 5 years. But I would say just expect to not be with that $50,000 for 5 years, just to be on the safe side and just to feel truly comfortable and not have to worry while your money's kind of tied up in the property.
Our first investment really was with Grant Cardone for $5,000. I mean, that's what we had at the time, and it really helped us. I would have liked to have done something bigger, but it got our foot in the door, and it helped motivate us to start. Then we did a larger LP investment, and then we got active later. So you may find that don't want to be active now, and down the road you do, but it definitely kind of gave us the bug and let us know that there were opportunities out there.
Well, yeah, and that's the other thing too, is that you're talking about being active. Some people want to be active. Some people want to have the control and they want to be able to make decisions and have voting rights. And that's not what this is. So to become a limited partner in one of these opportunities, you really are just completely passive. So you're not attending meetings and expressing what you think the paint color should be or something like that. Um, And I think, most people probably enjoy not having to make those decisions. But this is great for those who do not want to deal with tenants, termites, and toilets, as we like to say.
Exactly. And you do get updates, you should be getting monthly or quarterly updates, that will really keep you involved in the process and let you know what those paint colors are in the property and what the financials are doing and all those things. You're just not the one having to figure that stuff out.
That's right. And hopefully you're seeing that and going, phew, glad I didn't have to be part of that decision making.
Yeah.
Um, all right. Yeah. So that's really it in a nutshell. We love to build wealth together, the active investors and the passive investors. We kind of feel like it's a real win-win. So, Sam, where can people find you if they want to get in touch with you?
They can find me at lakecityequity.com and you can email me at sam@lakecityequity.com.
Perfect. And you can find me at brightsoundinvestments.com. So, thank you, everybody.